Okay, so Wall Street's fiercest activists just took a board seat, and suddenly management is out here promising steeper margins and brand new AI billing models. The timing on that is pretty incredible.
Right. Well, it is entirely predictable. When Jesse Cohn walks in the door, the grace period is officially over.
Very true. It is May 27th, 2026, and welcome to Earnings Unscripted. We are breaking down Q2 for Synopsys, ticker SNPS. And just as a quick reminder, this is not financial advice, just our personal opinions, so please do your own homework. But Miro, let us talk about the market reaction first. They had a huge run-up heading into the print, closing around 534. But today's tape was kind of brutal.
Yeah, the stock basically drifted lower all regular session and then gapped down hard after hours. I think it hit a low near 486 before pairing some losses. It ended up netting about a 3.6% drop from yesterday.
Which is weird because they technically beat their own internal guide.
They did. Revenue came in at $2.276 billion, but that is still a 5.5% drop from Q1. You're comparing it to $2.4 billion.
Right, but we knew that was coming because of the Ansys seasonality stuff. The Q1 numbers were just structurally bloated by that deal.
Exactly. Everyone models that in. But the problem is when you pair that expected sequential drop with a GAAP net income line that just falls off a cliff. It was down almost 74%.
Wait, sorry. GAAP EPS was down to 9 cents, right? From 34 last quarter?
Right. Now, they posted a non-GAAP EPS of $3.35. Very solid. But the market looks at that massive chasm between GAAP and non-GAAP and sees all the heavy stock-based compensation and restructuring costs still bleeding through.
Fair point. Though they did fully pay off that $3.5 billion Ansys term loan in Q1. That frees up a ton of breathing room moving forward.
It does. They generated roughly $575 million in free cash flow this quarter. But again, you bring Elliott Management onto the board and suddenly the non-GAAP operating margin at 39.5% is not enough. The CEO is out there committing to a 300 basis point improvement this year alone.
Always squeeze the margin. But I actually want to look at the top line for a second, specifically design IP. That segment jumped almost 12% to $454 million.
It is the bright spot for sure. Management is saying the segment bottomed in Q1, and that recovery is almost entirely driven by the hyperscalers.
Google, Meta, all those guys building their own silicon?
Yes, the custom-owned tooling trend. They're bypassing traditional merchants to build proprietary data center chips, but they absolutely need Synopsys to do it. Every single one of them is licensing Synopsys IP to piece these architectures together.
Which makes total sense when you hear the stories from the field. Like, the CEO talked about an AI accelerator chip that generated so much thermal pressure that it was practically a physics crisis. They had to use this multi-physics fusion software just to keep the chip from melting on the assembly line.
It's treating a microchip like a fluid dynamics problem.
Exactly. The whole thing is wild. All right, let's get into the details on how they're actually funding all this, because there's some fascinating accounting stuff going on here.
Right. Well, it is not so much funding as it is just pure accounting mechanics. You are talking about the Ansys channel shift, right?
Yeah, because I was looking at that top line beat and wondering how much is organic versus just, I don't know, moving numbers around on the spreadsheet.
A decent chunk is just moved numbers. What happened is Synopsys took more direct oversight of Ansys's third-party channel partners, and because of that, accounting rules triggered a shift to what is called a gross basis revenue recognition. So it artificially pumps up both revenue and expenses by about $12.5 million this quarter.
Okay, so it looks like extra sales on the top line, but it washes out completely at the bottom.
Exactly. Completely neutral to EPS, completely neutral to cash flow. But if you don't strip it out, the optics are, let's say, very convenient when you're trying to beat a top-line guide.
Just a little $12 million cushion. I mean, fair enough, but looking past the accounting noise, the actual structural shift they're making in how they bill customers is kind of massive.
You mean the agentic AI rollout?
Right, because historically, electronic design automation software, it has always been these very steady, almost boring 3-year subscription licenses. You pay for the seeds, your human engineers use the software, done. But now they have these AI agents autonomously designing chips.
Yes, and this is where the business model completely fractures, in a good way for them, because a human works, 8 or 10 hours a day? An AI agent is running chip layout workflows 24/7, so they can't just charge a flat subscription anymore. Ghazi, the CEO, actually spelled this out. Let me find the exact quote.
Yeah, what did he say?
He said, the current thinking is how do we build from the subscription license for human engineers to subscription plus consumption for the agents?
Okay, wait. Subscription plus consumption. Does that mean it is acting more like a cloud computing bill? Like every time the AI agent runs a simulation, a meter is just spinning.
That is exactly what it means. It is basically a SaaS consumption overlay. They are tracking how much compute these agents burn through. He noted they already have 20 customers evaluating this across over 25 specialized AI agents. So that's front-end verification, analog flows, things like that.
The phrase agentic engineer is, well, it's mildly terrifying. But from a revenue perspective, it's genius. Because if these chips are getting so complex that you physically need AI to map out the thermal properties, the customer literally has no choice but to pay whatever that consumption meter says.
Right. The switching costs become essentially infinite. Take high bandwidth memory, for example. HBM is the biggest bottleneck for modern GPU manufacturing right now. Synopsys just finalized an industry-first HBM4 IP test chip this quarter. If you're a hyperscaler rushing into next-gen silicon, and Synopsys is the only one who can make your HBM4 architecture actually work, you just pay the bill.
Which loops us right back to Jesse Cohn and the activist pressure. If you have that kind of pricing power sitting there and a consumption model taking off, no wonder Elliott Management is demanding wider margins. The leverage is obvious.
Yeah, the ANSYS synergy execution set the table perfectly for a classic cost-cutting sprint. And because they managed to use cash to completely pay off that $3.5 billion term loan, back in Q1, the balance sheet is surprisingly clean right now. It's clean enough that they even launched a $250 million accelerated share repurchase this quarter.
Oh, wow. Okay, so they are really playing offense with the cash flow now. So where does this leave them heading into the back half of the year then, especially with all these internal transitions happening at once?
Well, management is definitely projecting confidence. They actually bumped up the full-year revenue guide by a net $55 million. So they are targeting right around $9.6 billion now, and Q3 looks solid. But look, here's the catch.
Wait, I know that tone. What are they hiding under the hood?
It is the restructuring costs. They booked over $115 million in restructuring this quarter alone. That is on top of, $118 million back in Q1? So their GAAP earnings are taking an absolute beating, even while they promised this beautiful 41% non-GAAP operating margin.
Ah, right, because to deliver that margin for the activist investors, you have to actually pay for the consolidation. It is basically severance and reorganization costs masking the real bottom line.
Exactly. And honestly, they kind of need to force that margin expansion because the macro picture is incredibly fractured right now. Management openly admitted their outlook has to stay pragmatic because chip design starts in China are genuinely challenged by U.S. export restrictions.
Yeah, that makes sense. Because if you look at their traditional markets, things like industrial or automotive silicon, those are completely stagnant. It feels like the hyperscalers are just carrying this entire ecosystem on their backs.
That is the real takeaway of the quarter. Complete divergence. As long as Google and Meta keep burning cash on custom AI chips, Synopsys wins. But if that hyperscaler spend ever decelerates,
there's not much organic momentum in the broader market to catch them.
Which brings it all back to why Jesse Cohn is in the boardroom. When you cannot rely on broad market growth, you just pull the efficiency lever.
Right. Ghazi literally promised this on the call. He said, and I quote, "We are raising our operating margin by more than 300 basis points," unquote. That is not just a casual goal. That is a directive.
A life-saving tactic that involves a 40% operating margin. Truly a tragic situation.
I know. My heart bleeds for them.
All right, on that incredibly cynical note, I think we have said what needed to be said. Fascinating quarter and a slightly terrifying AI future to watch. Thanks for hanging out with us on Earnings Unscripted, everyone.
Catch you next time.
Just a quick reminder, if you want these earnings breakdowns to automatically show up in your feed, hit follow wherever you listen. The show is generated with a bit of AI assistance, basically just taking those dense company filings and turning them into something you can actually survive listening to on a commute. If you have a ticker you want us to pull apart next, shoot a note to earningsunscripted@datamadness.ca or find the X link in our show notes. Have a great week.
See you on the next one.